China's weak second quarter continues to raise alarm bells for economists. The world's second largest economy saw GDP grow 6.3% from a year ago. That, though, was lower than analysts and economists had estimated, and it showed a slowdown from the first quarter. That disappointing print caused major banks to cut their year-end growth forecast for the country. JP Morgan, Citigroup, Morgan Stanley all downgrading their projections for economic growth this year to 5%, putting Beijing's official gross domestic product target of around 5% at risk potentially. Deflation is a major risk now for China, with data showing economy-wide prices declining for the first time since 2020. Lori Calvasina is still with us, RBC Capital Markets head of U.S. equity strategy. I know you don't cover international stocks, you cover U.S. stocks, but obviously China has been quite important for the U.S. How should we think about the current growth profile in China and what the implications are?
So I do talk to a lot of global investors, even though I don't cover global markets specifically. And one of the things I was struck by at the start of the year was just how complacent the bullishness was on China. And even, sort of middle of the second quarter, I was still talking. I did a trip over to Europe, and I was still, talking to a lot of folks over there who were, telling me how great the Chinese consumer was and how great the recovery was. And I said, well, I just came out of a reporting season where there was a lot of mixed commentary from the U.S. companies, and they were managing it pretty well, but they weren't, just sort of ringing the bell and celebrating and say, hey, everything is great. I think there are spillover effects. I think they are manageable in the U.S. That's certainly what we've seen so far. I don't think the planning was for a lot of optimism around China in the U.S. the way it may have been with European companies. I think the spillover effects will be greater in Europe. Because they were all, all the investors I were talking to were sort of singing how they were going to benefit the most, so that reverses. But I think beyond just sort of the ability of it to impact our economy, it's impacting money flows. And if you look at data from EPFR, you can already start to see the inflows to China fading a little bit. And so we had seen all this money wash into China, all this money wash into Europe to start the year. Well, guess what? The European equity flows are now negative. China is topping out. We're seeing money going into Japan. We're starting to see it pick up for Canada. And guess what? It's picking up in the U.S. as well. That was originally driven by growth funds. Now it's morphing over into value funds. It's broadening out a bit. So yes, there's the knock-on effect to our economy, but it's actually quite positive for the U.S. from a money flow perspective if you stop some of that money going into things like China and bring it back to the U.S.
Okay. Does that then make us too insular, redirecting it? You wonder if it limits just the emerging market and international exposure in general.
I think in general, I started back in 2000 over at Citi, and I used to call it the gospel of global growth. It was just the world is going global. We used to have to do all these studies where we pick through financial statements and find the international exposure and the China exposure, and that stuff used to be really hard to find, by the way. And now that's all reversing, right? So to the extent that we are a little more insular, I don't know that investors care that much because right now the really, kind of sexy theme out there is reshoring and reindustrialization. And all these crises we've had, the trade war, the supply chain shock, COVID, the inflation shock, it's all convincing us we need to invest more at home, and that train has already left the station. So that's really the big theme that people are going to be playing the next few years.